It's now time for an in-depth look at the global markets this afternoon, and for that I'm joined on the line by Dr. Hwang Sei-woon, Research Fellow at the Korea Capital Market Institute. Dr. Hwang, thank you for coming on today.
Thank you for having me today, too.
Stocks on Wall Street started the week down on Tuesday. The S&P by about 0.7%, the Nasdaq by more than 1%. Korean stocks, though, a little higher. What's the story today?
In Wall Street, stocks ended lower Tuesday after the world's two largest economies began imposing new tariffs on each other's goods. Weak manufacturing data also dented market sentiment. Stocks hit their session lows after the Institute for Supply Management said U.S. manufacturing activity contracted last month for the first time since early 2016. Investors loaded up on traditionally safer assets such as gold and long-dated treasuries. Gold futures for December delivery rose more than 1%. The 30-year Treasury bond yield traded at 1.95% after hitting an all-time low last week. Asian stocks rose on Wednesday after a report showed growth in Chinese service sector accelerating despite broader economic headwinds, while the pound halted its decline on hopes a no-deal Brexit may yet be averted. Korea's Kospi and Japan's Nikkei gained 1.16% and 0.12% respectively. Hong Kong's Hang Seng also ended higher by 3.53% today.
Now, Dr. Hwang, we've seen the Chinese currency reaching lows against the U.S. dollar not seen since 2008. What effect does this have on the global economy, and how long will this go on?
Global currencies have been pushed front and center as trade tensions between the U.S. and China have escalated. Of particular interest to many watchers is the relative strength of the dollar versus the Chinese yuan, which sits at multi-year lows. The trade war has led to a historically weak Chinese currency, and the impact would spread globally. If Chinese yuan depreciates further, it could end up weighing on the currencies of other emerging market nations. For the rest of emerging market countries, yuan weakening carries contagion risk and adds to an already unsettled environment. This implies that further depreciation of yuan would put more downward pressures on emerging market currencies and the index tracking them. The yuan is expected to continue its depreciation as long as the trade disputes between the two countries intensifies. In other words, the yuan has a natural tendency to weaken for a while to partially offset the impact from President Trump's tariff imposition.
All right, now yesterday we saw that Korea's consumer inflation for August came to 0%, unprecedented. What does that mean, and are we at risk of full-on deflation?
0% inflation shows that the domestic demand is really weak. This implies that the economic growth rate for 2019 is more likely to be below 2%. South Korea's export-reliant economy is grappling with slowing exports and sluggish domestic consumption. Markets will view weaker inflation and economic growth data as factors that increase the probability of a rate cut by the Bank of Korea. Korea is not in a situation of deflation yet and more likely to experience very low inflation period in the medium term. Given that low consumer prices are caused by a decline in oil prices and stabilized agricultural and fishery prices, it is not proper to consider the current situation to be deflation. However, if the weak inflation continues, Korea's economic growth momentum could be even worse. The weak inflation, together with declining economic growth rate, would significantly increase the possibility of deflation. Therefore, Korean government, along with the Bank of Korea, will have to prepare policy measures to prevent deflation from happening.
All right, Dr. Hwang, we'll keep watching those figures. Thank you for coming on and sharing your insights today.
Thank you very much.